Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to do part 2 in my series on Westwood Holdings Group. We're going to talk about the company's operations. In general, the company's operations are pretty good, but to be completely honest, that's really looking at this company with the most generous eye possible, and it's really looking at past performance as much as current performance. Current performance hasn't been as good for a number of reasons. But I believe this company is well run and in a good industry and is going to make a good comeback, which is one of the reasons why I think we should invest in it. However, as I've said before in the overview section, I also think the company has intrinsic value if it was just to be broken up for its cash. As always, when I'm analyzing a company, I start by looking at the gross margins. It's the number one thing that I look at. And despite the fact that this company has had some rough times and is going through rough times right now, you can see that the gross margins for this company, at least as of 2019, were above my sort of desired gross margins of 40%. So even in the bad times, this company is better than a lot of companies that I would consider uninvestable, and it is in the range for companies that I think are good and solid. So the gross margin of this company check out, which is one of the reasons again why I continue to look at everything else about the company. Obviously, this chart, which looks at earnings and earnings per share, is sort of terrifying, right? As an investor, you go, oh my God, why do we want to own a company that's falling off a table like this? And the first half of this year has been slightly worse, although again, I think that's exacerbated by COVID. The thing that I want you to keep in mind is that this company made about $6 a share, or about $6 million in earnings in 2019, and let's assume we could do that consistently. This company is also traded at 20 times earnings consistently. So if we can earn $6 million in profit and be at 20 times earning, that makes us a $120 million company. And the market cap today when you're buying this company is about $95 million. So just at the level of this huge drop, we see that the company has a reasonable expectation to maintain its current level and or to go up 30% if we can do its 20 times earnings. Now, should the company make a bigger rebound, then we can really, really do well on this stock. And again, I've got the backstop that the company has $120 million in assets and about $87 million in cash. So when you take all that into account, you start saying that even though this thing has dropped off the table, Ben Graham would tell you this company still has an intrinsic value and that the intrinsic value justifies paying the $11.23 a share that I paid for the company. So net earnings as a percentage of revenue for this company are sort of scary again. We're going to say that a bunch as we go through this stock, that things don't look really good right now. And you can see that despite the fact that for most years this company was trading above our goal in terms of having a net earnings as a percentage of revenue, in the last year it's dropped off pretty significantly. Again, I believe that's a short-term thing. I think this company's going to make a turnaround. Even if it doesn't make a turnaround, this company has a high value if it can just do what it did in 2019 consistently. Even though this chart looks ugly, if this was just to become flat going forward at the level that it's at now, we'd still be a $120 million company. And so that's fine. You can the chart next to it, net earnings as a percentage of revenue, is just to give you a sense of scale. So other things this company could do if they were to stay at this level of revenue, they could simply cut their costs, their facilities costs, their plants and equipment. They could cut their selling and general administrative. Obviously, they're not getting good returns. We're going to talk about them in a minute. But obviously, currently, they're not getting a great return on their sales and general administrative costs. And in theory, if this was the new number they could do, they could reduce those costs significantly and thus increase their profits. So again, I think they could reduce costs. I think they can go back to normal. You're going to see some other things that give me reason for hope that again, this company's going to return to its glory and make us a lot of money. So selling and general administrative, you can see that I'm a little unhappy that this stock, selling and general administrative cost, has gone up really as a percentage of gross profits has gone up every single year since 2014, and now it's really, really too high. But part of that is because the gross profits have dropped so dramatically. So it's sort of the selling and general administrative hasn't gone up the way this looks like it has. It's just the gross profits have gone down while selling and general administrative have gone up. I expect that will correct itself. I expect the gross profits to increase, which will pull that number down. And then hopefully selling and general administrative will be in better line going forward. Plants and equipment's the same thing. I don't look at plants and equipment as a raw number. I look at it as a percentage of assets. And this company's assets have decreased in part because they're buying back shares and doing some other things with their money. And so plants and equipment, if they were constant, they would look like they're going up. I think that number again will also normalize and we'll get back to a number that makes sense. By the way, it was still a little higher than I'd like it to have been for most of the time that they were there. But again, most of the time, that even though that was too high, the company was still getting great returns, earning good profits. So plants and equipment's a relatively minor thing for this company. So we're not going to spend a lot of time worrying about it. One of the real reasons that I'm not focused so heavily on plants and equipment. Let me start over. When I talk about these costs, I look at there are 5 taxes that a company has to pay that are kind of operating taxes. They're things that a company has to do to run their business, costs that a company has to have to run their business. And the better job a company can do controlling those costs, the more that company is something that I would consider to be very investable. Now, selling a general administrative, we have talked about that's too high, and plants of equipment, that's also too high. But the silver lining to that cloud is that the company has 0 cost for inventory and it has 0 cost for R&D. So even though the other two are a little too high, these 2 categories bring it back down into line for the total cost for what I call the 4 or 5 taxes. There's 4 taxes and interest is the 5th. Those things are all low enough that it sort of offsets the fact that the other 2 are high. And if these were all average, then I wouldn't talk about the other ones as being too high. They just say they're all average. But it all averages out in this case. The final tax is interest, and this is an interesting category for this company because they pay no interest, so that's great. That's a third, 3 of the 5 taxes, they have no cost. But in this case, it's even better than that because they have interest income. Now, they've had significant interest income for a number of years. In the last 2 years, it's dropped off pretty dramatically. And that's one of the reasons this company isn't as profitable as we'd like it to be. I think some of that's going to recover. I think they're going to make some less interest because they've been spending money, for example, to buy back shares. But I think they're buying back their shares cheap enough that it's going to turn out to be a good play as well. So again, a lot of companies have interest expense. This company has interest income, which far outstrips their interest expense. So not only is it not a tax, but it's a revenue source, a profit source. So that's really, really strong. And that's, again, one of the reasons why I like this company. So this is sort of the summary of what I think about in terms of operations for the company. First of all, I look for companies with a gross margin of at least 40%. So this company's gross margins have consistently been north of that number. And for the last several years, even though the company's been less impressive and the profits have been less impressive, they've managed to keep their gross margins where I'd like them to be, which is a good sign. The company's earnings have been poor. I'm betting that in 2021 they will rebound. If we would only make in 2021 what we made in 2019, and we can keep the 20 times earnings that the company has historically done, and that's pretty common for this industry, then this is a $120 million company. $120 million company when we're buying it for $95 million sounds like a pretty good deal. The company's selling and general administrative as well as plants and equipment are higher than I'd like them to be, but that's in large part because the analysis doesn't look at those numbers as a direct number, it looks at those numbers as a ratio, and the things that they are related to have done poorly, and I expect those things to recover, these numbers to get back in line. The company has no R&D or inventory costs, which helps make up for the slightly higher selling general administrative and plants and equipment. Also, the company has no debt and thus no interest expense, and in fact it has interest income. And finally, the company's had a major reduction in interest income, and I'm hoping that that number will recover over time. So that does it for the operations for the company. Here you see a map, which is where my known subscribers are. I'm not really getting anything out of this. I don't do any advertising, and the only thing I get out of this is sort of the personal satisfaction and ego boost, if you will, of having followers from all over the world. You can see that this number is growing. There's only about 25 dots on this map. I haven't counted exactly, but maybe there's 30 dots on this map. And I've got 220 followers, so I'd love to know where all of you are from. One of the things that I do, for example, I just had somebody who wrote me and told me that they are from the UK, but they didn't tell me what city. So if that happens, I just put them in a city in the UK that I don't currently have a dot. Doesn't do me any good to have a bunch of dots in Europe. They wouldn't show up. But I'd love to know where you're from. I don't do anything with the data other than put it on this map and kind of look at it and say, wow, I've got a follower in Tel Aviv. That's pretty cool. So wherever you're from, just drop me a line that says, hey, I'm in Chicago, or I'm in Perth, or Johannesburg, South Africa. By the way, I don't have any dots in Africa, so if you happen to be following me from Africa, just drop me a line and say where you're from, because I'd like to add a dot in Africa, maybe a bunch of them. So thank you very much for your time. I say this on all of my videos, but if you'd like real-time information on when I make trades, either buying or selling, The best place to find that information is at robinsonstocks.com. These videos take quite a bit of time for me to make, and I don't always get them out promptly when I buy or sell a stock, but I always post on my Twitter account whenever I do that. I also will put information for articles or videos that I find that I think are interesting for an investor, and so you get that there as well. So that's all I've got on the operations of the company, and next time we'll talk about the next thing. Thanks.